You could ask me questions too in comments, and I can answer your questions. But there are things that you could do to cut down your taxes if you're in certain situations. So, for example, if you're in your own business or you have a sideline business, there's many things you could do. There's more things you could do than if you were an employee, a W-2 employee. All right, so that's like the first cut. If you have children, family members, a house, there's more things that you could do than if you're living in an apartment. If you have money invested, there are more things you can do to cut down on your taxes than if you don't have money invested. So a lot of it depends on your own circumstances. But I will, not knowing your circumstances and the other people watching, hold on. What I'll do is I'll cover all the high points and then ask me questions. Just give me another. This is not the way to do a seminar, but it reminds me of once that I was doing a seminar for a group of CPAs about 25 years ago. It was about maybe 80 to 100 CPAs. It was a very complicated seminar I had to do and everything. And I left it, I got so carried away with doing the overheads back then there were like overheads that you'd put on this glass that it would show on a projector. I got so carried away and did so much detail, OCD stuff, fine-tuning it, that that I was running late and I had to drive an hour and it was already I was supposed to be up already. I go out to my car, the car didn't start, and it's raining out. So, I don't know, I got somebody to help me jumpstart the car, but he didn't hold the umbrella right as I'm drenched, and I get to the meeting that was about an hour away, and I had this raincoat on, and the people are like, this guy Paul, who set it up for me to be the speaker, I called him on the way up. I could hardly drive. It was raining so hard, right? I called him and I said to him, he says, that's okay, don't worry about it. You come in right after lunch. We'll have lunch. I was like the keynote speaker, but he says, we'll have lunch. So when I got there, I got in, I'm like drenched. I must have looked like a fright. At that time, I was living as a man. And then I got in, I had my raincoat on. It was like not even a really cool raincoat. It was like a beige raincoat. Anyway, as I walk in, Paul says, oh, we're just finishing up lunch. You could start now. He hands me the mic, and then I took off one part of my coat, and he grabbed that and took off the other part. I put the mic back in the other hand, and then I turned around to the audience. No setup. I had none of my slides, nothing. I had no material to hand out, nothing. And I think made a joke about it. And it turned out that it was the best seminar I think I ever gave. I worked out a lot of stuff in advance in my head during the ride, about what I was going to say and stuff. But still, I went up there with no material, and I had spent hours developing all this sophisticated material. So that was a lesson to me that it's okay sometimes not to be fully prepared. And it turns out that I did a lot of business from that. And like I said, it was probably the best. I gave a lot of seminars, a lot of talks, and it was probably the best one I ever gave. And you out there in Facebook Live land, you'll probably have many situations like that too. Just give me just a moment while I bring up. I have to tell this person that we're on to go on Facebook Live rather than rather than Zoom. I'm not even going to bother with it. Go on Facebook. I think it'll be more fun. Facebook Live under Fran Sisco rather than Zoom. And let me put the word please in there. Please go on. Okay. You know, it's a lesson on when you're doing taxes. Okay, taxes have gotten a lot easier over the last several years. And the Trump Tax Act, no matter what your political views about the man is or whatever, his administration, it did simplify a lot of stuff, and it did reduce tax rates. And it did provide extra deductions in certain cases or higher standard deductions, and it simplified a lot of stuff. You may not need an accountant or a CPA to prepare your taxes. Maybe you do it on your own. Maybe you got a relatively simple situation. For example, if you have a W-2, for a job, and maybe you got a 1099 this year for unemployment, compensation or something like that. And then you also have, let's say you're living in a co-op, for example, and you got a slip from them for the portion of your maintenance that is real estate taxes and interest. And let's say you have some money in a few mutual funds, and you get a 1099 from the brokerage firm or from Schwab or whoever you have your investments with. Some of that income could either be dividend income or interest income if it's a bond mutual fund, or it could be regular dividends like stock dividends, and they're subject to rates up to 15% generally, income tax rates, so relatively low rates. Also, you could have had capital gains or losses. So that's like a typical situation. And you may have money in the bank, but because the banks are paying usually less than 0.5% interest, sometimes if you have, for example, if you have, like, say, $50,000 in the bank, right? 10% would be $5,000. 1% would be $500. So 0.5% would be $250. So we're talking about relatively low amounts of money. But if you had that simple situation, you might be able to do you probably could do the tax return on your own with, let's say, a TurboTax program or tax help or tax cut. They have these different software programs. Or if your income is even low enough, and I forgot the cutoff, maybe it's $20,000 or $30,000, you could do a free online. The IRS provides free online tax assistance. So I just wanted to make clear that there are ways that you could do your tax return if you're in that situation, and more people are in that simpler situation, because now the standard deduction, as an example, is $13,000 if you're single, say $26,000 if you're married. I'm roughing out these numbers for you. And if you live in New York, well, if you live in any town, any state, but especially if you live in New York, New Jersey, Connecticut, high real estate tax states. So, for example, the taxes on my house are maybe $16,000. His taxes a lot higher than that, like $20,000, $30,000. But if you live in, the metro area, you're probably paying over probably $15,000 in real estate taxes. Before, you had the choice of standard deduction or itemized deductions. Standard deductions were lower than they are now. Now they're, like I said, like $26,000 for a couple. $13,000 if you're single. Your itemized deductions were once high. Often on, if you did your, say, return or had somebody do it for you, they were high because you paid, say, $16,000 in real estate taxes. Maybe you had some medical bills that was over the threshold, which is 10% of your adjusted gross income. Leave that alone for a while. But then you add your state income taxes, that were state taxes that were withheld from your pay or that you paid in estimated taxes if you were in your own business. And then you had a category called miscellaneous itemized deductions, right? Miscellaneous itemized deductions was a way, well, believe me, I'm a CPA for about 40 years, and I've had several businesses on my own. I know a lot about taxes, especially for small business people, and what tax strategies to use. I'm not saying cheating. I'm just saying using, smart ways to reduce your taxes. So in the case, going back to this now, we're talking about itemized deductions and the decision between standard deductions or itemized deductions. Now, itemized deductions included things like real estate taxes, state income taxes, things like that. Also, the contributions to charity, that was in itemized deductions. Then you looked at this category, miscellaneous itemized deductions. Boy, I really earned my pay with that. When I would do a tax return, I would find those business expenses for that person that was, say, teaching golf on the weekend as a sideline business. Man, we can come up with a lot of expenses against that income. They were allowed, they were called miscellaneous itemized expenses, business expenses against that kind of income. Also, payments to accountants for doing tax return preparation was an expense. Another big expense for business expenses as an itemized expense were travel and car expenses when you were an employee. So let's say you had a salesman job, whatever. Let's say you sold whatever. You sold vacuum cleaners or something, and you had a lot of travel expenses. But you were receiving a W-2, a form W-2 at the end of the year. You probably got it in February for the previous year, and that showed you your salary. Let's say you made $100,000 from selling vacuum cleaners. Well, you also had these business expenses. Let's say your employer deal with you was that they weren't going to pick up any of the expenses. All the expenses were you're on your own dime. So what you did is you deducted that on Schedule A, itemized deductions, along with your real estate taxes, your state income taxes, your city income taxes. If, say, you lived in New York City or in Yonkers, they have a city tax, or, several other cities. You add it all, and then you added up your contributions and everything. Now you had a pretty big amount, with your $16,000 of real estate taxes or whatever it was, and $4,000 or $5,000 of state income taxes, and another $1,000 of contributions, where, by the way, not just cash contributions, but if you cleaned out your closets, you'd come up with $1,000 or $2,000 or $3,000 worth of fair value of clothing and little household items and old tools and stuff you would give away. So it wasn't unusual to come up to $20,000, $30,000, even for, say, modest income, middle income, say up to $150,000 to $200,000 of annual income, which once many years ago, that would put you in like the top 5%. Now you're just mainly eking by, $150,000 a year. And if whatever you make in 1 year, you often lose it in the next year. So anyway, not passing judgments on if you made $5, everybody is an important person, and they're valuable to themselves, to their family, and to this country and world. So going back to this point about itemized deductions, it's a shocker now for many people. This is going on now the second or third year, actually, where they're not itemizing. They're not able to itemize because their property taxes deduction is limited, and state income taxes is limited to $10,000. So there goes a lot of their deduction as it is. Their medical expenses have to go to be more than 10% of their adjusted gross income. So let's say their adjusted gross income was approximately $100,000. 10% of that is $10,000. That means that their medical expenses had to be more than $10,000. Let's say it was. Let's say they didn't have dental coverage and they had, implants and stuff, and they spent $15,000 on that stuff. Well, it had to be above 10% of the AGI, adjusted gross income threshold. And it's only the difference. So if it was $15,000, you got to minus the $10,000, you get down to $5,000. So now in this hypothetical situation, we have $5,000 of medical expenses, and that's in a year that you had a lot of expenses with these implants. You had $10,000 worth of real estate taxes and state income taxes and city income taxes. So now we got 15 so far, right? And what else did you have? Contributions. All right, you had $3,000 of contributions. So now you got 15 plus 3 is 18. You don't have any more of these miscellaneous itemized deductions, which included all of those business expenses. It included the tax preparation fee, and it included another important category. Many people have money in mutual funds and other investments with broker dealers, and they pay, instead of paying commissions, they pay a so-called asset management fee, typically 1% of assets. So let's say you're lucky enough to have $400,000 in, or you worked hard enough, whatever the case is. You have $400,000 in investments. You paid $4,000 for fees. Used to be deducted on Schedule A. No longer. Can't deduct it. So in this hypothetical case, that's out. So now you're stuck with, you have $18,000 of itemized deductions. Your standard deduction as a couple is already $26,000. So it's a no-brainer. So you do the standard deduction. That simplifies things. So when you're setting out to do your tax return, if you did it thinking it was like it was years ago when you would spend days and nights finding all these receipts and scheduling out all your bills and everything. Now if you do it, chances are, they say it's in 50 to 60% of the cases, people cannot use itemized deductions any longer. You save yourself a lot of time, especially if you didn't have any significant medical expenses, like in this hypothetical case of this person having those implants. So the number one thing you do if you're, who's typical nowadays, right? Who am I to say, right? But is to work out before you sit down to do it, before you engage. Let's say your CPA moved and you're looking for a new accountant and everything. Forget what you did in the past. Find out what your situation is currently. What I would suggest is, look, I'm always looking for new business. No question about it. I'm not going to be able to retire until I'm in my 90s, late 90s probably, right, money-wise. But I'm always looking for new business. But I'm not here to just glom for business. And it's also so important that you get someone who's you can do everything by email. I do that. I have clients all over the world, actually, all over the country at least, and I have some in other countries, all over this country usually. But Florida and California, New Jersey, Pennsylvania, Ohio. But the most important thing is you got to be compatible with whoever it is that's doing your tax return. I have not had a great experience. Some people have had a great experience going into an H&R Block or whatever the other names of the others are, and they many times are very capable and they've gone through the training and stuff. I'm more of a one-on-one kind of person. Maybe I'm just used to that. So my attorney, I got to be able to reach that attorney and speak to that person. I can't go walk into an office and sit in a lobby and go through whatever. Especially now with COVID and stuff, I have to have a very personal relationship. So you need a lifetime. Whenever you're getting an advisor for taxes, it often bleeds into other areas. So, for example, let's say you were getting someone to do your tax return. You weren't planning to get married. You got married. Let's say you were planning to, after that you had a child, and after that you had bought a house. So you have to really anticipate that these are other business decisions that you may need the help of an advisor, which often is the accountant, right? It could be that it's a financial planner, but usually a financial planner would be, you really need at least maybe $200,000-$400,000 of investable assets for them to make enough money on the fees related to those assets. Like I said before, if it's the typical asset management fee is 1%, 1% on $200,000 is $2,000. Probably most people are not going to develop a relationship with someone else unless they could at least earn $2,000, in that situation, because then they got to share that with the house that they work for, the brokerage house that they work for, and stuff like that. So it's often that your accountant ends up giving you advice on a lot of these other business areas. So getting back to it, when you're setting out to do your taxes for this year, number one, and we're going to cover this now, you got to do things before year end. Certain things you got to do before year end, or else you're going to find that someone's going to say, well, did you do that? And you're going to say no. And you just lost the benefit of saving so-and-so dollars. So the number one is, and we're going to cover that, you got to do things before year end. And I have a let's see, it's 3 pages. It's not a year-end tax and financial planning for December 2020. I sent it out to all my clients over the last few days for them. I posted it actually up to Facebook. So you look under Francis Sisco. It's Francis, and then Sisco's Sisco. Look under my Facebook page. Recently, I think I posted it up there this morning or last night or something. And it's called Year End. You could search on Facebook, Francis Sisco. I use the name Fran, but Fran was taken for Facebook, so I used my baptismal name, Francis. So anyway, Year End tax and financial planning for 2020. That'll have a lot more detail about what we're going to talk about right now. And I broke it down under pandemic. I think it's backwards here. I don't think you can really see this. Pandemic-related matters, employees, small business owners and gig workers, investors and real estate investors, and individuals and families. So what you could do, you may hit all of these points. You might have your own business, be an employee, you got stuff happen to you in the pandemic, and you're an investor and with real estate. So you read the whole thing. Big deal. It's 3 pages. So it's the highlights of what you should do. Now let me give you some ideas right now. So again, make the decision who you're going to use, how you're going to compensate them, and what you really expect your tax return to look like. One way to get to that answer without having a lot of tax experience is you get a copy of your last 2 tax returns and you give it to someone you're thinking of and say, how does it look what was done? And these are what my current situations are. Since that tax return, whatever, I sold that house, or I divorced that person, or my daughter went to college, or or I had a loss in a side business and I closed the business. You go over all that detail. When you get that detail to that new person, they could say to you, well, I think it's going to cost you $300 for me to do your tax return, or it's going to cost you $2,000 for me to do your tax return, and they'll give you a good idea of it based on the past plus what your current situation is. So here they're coming up now. All right, this is like those commercials where they tell you they're going to give you something and it doesn't happen until it keeps going and going, or like those videos, those videos for doing a course, start your own course. Like you'll make 8 digits of income a month, and all that, right? Anyway, I said I'd start with investors because this is stuff you got to do next week if you're going to do it. Go through your portfolio. I'm now assuming that you got money invested. Forget about it. If you only have $50,000, it's not even worth talking about. But if you have some serious money invested, I'd say over maybe $200,000-$300,000, look through the portfolio. Let's say you have a combination of stocks, certain mutual funds. You got some ETFs, exchange traded funds. And let's say that covers most of it, and maybe you got a couple of bond mutual funds. Look through them, see what's losses, what you have paper losses on, all right? And consider selling it. Because if you sell it before the end of the year, you're going to record that as a loss and be able to offset that loss against your income, okay? So, against the income from your gains, and if there's any excess over and above that, up to $3,000 per year, and if it added more than that, you can keep carrying that forward. Now, some people say, well, wait a minute, I don't want to sell this. This fund is going to go, this fund invested in in pandemic related vaccines. It's losing money now, but it's going to make a lot of money in the future. Well, if it's in a fund, chances are it's not the only fund of its type in the world. You could sell one fund, right, that has, say, 10 stocks in it that relates to the pandemic, and you could buy another fund that has 10, maybe a different 10 stocks, or maybe the same related to the pandemic, and you accomplish the benefit of a tax transaction in 2020 to record the loss, and you're still in the game if you want to be in that game. Like you don't want to give up on that industry that you invested in or that particular stock. Also, as long as it's not substantially identical. There's another strategy. It's a little more complicated. You can always call me about it. But when I was a stockbroker with Prudential Beige, and then with Prudential, and then with Walnut Street Securities and Cetera and stuff, I did a lot of, mainly with Prudential way back in the 80s. I did a lot of buying of call options, So let's say you had a $20,000 position in a stock, and you were losing $4,000 on it. And meanwhile, during the year, your broker had sold you a lot of stuff and you made gains. Because, the last couple of years generally has been pretty good with the stock market. And you made gains. Well, you could take that loss and offset it against the gains and save all those taxes on that. Now, the tax rate on gains and losses is lower now than it used to be, and it's lower than ordinary income, but you're still saving hundreds and hundreds of dollars. And you can buy, going back to that call thing, you could sell a stock, be out of that. Let's say you had that big position, like say $20,000 in one stock. You could sell that stock, get the loss, use the loss, and then buy a call option on that stock. And that will count as still a valid sale and not a so-called, I don't want to get too technical about all this, a wash sale. You can't just sell something and buy when these calls come in here. But all right. So anyway, so now that's one idea. So far, we only talked about one idea. Look at your clunkers in your portfolio. Sell the losers, unless there's really strong evidence that you shouldn't sell it. But there are ways to still stay in the game. Like I said, you could buy a different fund that's doing the same thing if you really believe in that. Maybe it's just a bad deal. You got into it. You really wanted to sell it. This gives you the ammunition to sell it. All right? Sell your clunkers, you know, and don't be too tied to them. Okay, now, talking about investment, and let's talk about the pandemic. I have other specific things about the pandemic, but let's say you're in a business. Let's say you have a restaurant. You know, I really feel for you. I've had businesses that didn't make money, or they made money and then all of a sudden they lost money, and it could really wreak havoc on your financial situation. But let's say you had a business, and let's say you lost in 2020, when it's all said and done, God forbid, but you lost $100,000. A lot of people lost millions, but let's say you lost $100,000. Well, you're going to use that loss. You don't just put the loss and mention to your accountant that you had a loss. You're going to actively go to that loss and use that loss to, depending on what you have. So let's say it was a S corporation that you had, or you had a partner, or you had an LLC. Let's say you didn't have a partner, you just your own person. You could take that loss and you could use that loss against your other income. So if, just for an assumption, you have a $100,000 loss and you're able to use it, and you were ordinarily, you had other income coming in, you had another business, you own some property, whatever, and you could use that. You could save roughly, including state taxes, roughly 30%. So using a $100,000 loss, that's the silver lining with the losses. You'll get to use that loss against other income. Now, if you can't use the loss this year, you could go back and use the loss amending returns in the past. And if you didn't do that, you can go forward and amend them. So now is the time to look at those businesses. You're at year end. You only got another week to do this. And let's say you have this restaurant and you say, well, so far I lost $100,000 this year. Well, you know what? You lost more than that, probably, because if you lost $100,000, your business, maybe it's shot. Maybe you're not going to be able to recover out of this. And who knows about how fast we're going to get out of here, get out of this situation with vaccines and stuff. Maybe it's time almost to pull the plug. But even if you're not willing to shut the door, lock the door, give the landlord the key and say you'll take care of him at a future date, even if you're not ready to do that, what you could be ready to do is get smart about the taxes and say, look, I got all of this inventory that I had, all these dry goods that I had that I used to use in my, they're shot, or I'm not going to be able to use all of them. For 20 years, I'm not going to be able to use, because I'm not going to have my volume back. I'm not going to use the equipment that I was planning on. You know, all this computer equipment that I had in here, I'm going to scale back. I'm going to move to another location, and that's maybe a higher traffic location. I can't spend money on advertising. Whatever bills I have already for that, maybe I got to pay them. I'll add to the loss. Create as large of a loss as you can, because you know what you're going to do? Let's say you had made money in the past and you built up money in your IRAs or your Keogh plans or your profit sharing plans or whatever you want to call these retirement plans, that you socked money away to reduce your taxes. You used to put money in these plans. This is the perfect time to take them out before the end of the year. I have some clients, we've taken out money use the losses against, when you take money out of an IRA, let's keep it simpler. Take money out of an IRA, it's taxed. If you're in a, say, 30% tax bracket with state, you take out $20,000 times 30%, that's $6,000 of tax that you're going to have to pay. Guess what? If you have losses that you could use to offset that income coming out, that's a great time to take the money out of IRAs. What you might even, to finesse it, instead of just taking the money out of IRAs, what you do is you convert it to a Roth IRA. So not only is your money out and not now free of any tax on it when you go to withdraw it, as long as you stay with the Roth IRA a certain amount of time, maybe you do half Roth IRAs, half completely out. In the Roth IRA, that money multiplies with no tax. And there's no required minimum distributions on it, as is ordinarily the case at 70 and a half, or now lately for people born before a certain date in 1949, it's up to 72 is when retired minimum distributions happen. So anyway, that's like the second, for investors, main thing you got to do. If you have losses, spend time and talk to people. Get second opinions. Right? If you call up your account and say, well, what do? I have these, and they give you one answer. Believe me, I'll definitely help you out. But if, whatever, I'm in their shell. If you want somebody that you live in Tenafly, or you live, in whatever, and you want somebody around the corner from you, I'm not your person. So whatever you get an answer, double check it, do a little research. Okay? Unfortunately, I've had losing businesses over the years. Not all of them. Some of them made money. But the ones that lost money, I always made sure I squeezed every darn nickel out of the taxes for it. Okay, so that's your those are two ideas for investors. Now another one, one's a little more complicated. This one is a little more emotional, but I feel it's very important to bring up. It's almost, I even had a hard time writing it down because I didn't want people to. Anyway, it has to do with people who are going to die, especially family members. And, sometimes you could say, oh, it's not, or no, I don't care about the money. All of that doesn't mean anything. No, I got to just focus on caring for them and being with them in the days that are left and everything. Yes. Okay, I agree with that. Except if it could save a lot of taxes, and those savings aren't going for a better BMW or, an extra level of decorations in your house. Those savings are probably going for the education of kids, or they're going for medical expenses. They're going for something important. So anyway, I'm going to bring this up. Let's say you have a couple, all right? So this is this kind of negative or touchy area. You have a couple that they own, and many of the older people in their 90s have substantial assets, if they haven't spent them all on home care lately. But let's say they have, let's make the number $500,000 in a stock that they bought when they were in their 20s, and now it's like, and they will never sell it. They'll never diversify. They'll never sell it, right? They have this stock, and it's a $500,000 stock. And they have it jointly owned, husband and wife. And let's make it, usually it's the husband that's dying first. Let's make this one, the wife is dying. Unfortunately, the wife is dying. And let's make it so that she's 95, so it's not as hard in the example, and he's 95. Now, if she she dies, he inherits the stock at, after her death. And let's say he gets sick, and now he dies the next. He's going to sell the stock because he needs it for his care. Well, he has that stock is $500,000. Let's say they paid $50,000 for it. They have a $450,000 gain. They're going to pay taxes at about 20%. So that's about $90,000 in taxes. Here's the strategy that's sometimes hard to swallow. It's called step up in basis. Step up in basis, cost basis. What you do is you take they had it jointly owned, right? Now what you do is you take and split it up. $250,000 for one, $250,000 for the other. Now, when the wife died, I got you back. Oh, I got you back. I'm sorry. When he's gone, I'm just going to let them ring, all right, if you don't mind that. So anyway, this example of she's dying. Before she dies, you split the stock up. Doesn't have to just be stock. Could be mutual funds. It could be, ETFs. It could be a million things. You split it up, and now $250,000 is in her name. She dies. He has the $250,000 that was split in his name. Now, after she dies, what does he have? He has $500,000 of. He inherits her stock. $500,000 of stock. There's a rule that you step up the cost basis to the date of death value. So when she dies, the stock gets stepped up from, say it was $50,000 when they bought it together, stepped up from that all the way up to $250,000. So he could sell that $250,000 worth of stock technically the day after she died and zero gain, no tax. So now he just has to worry about the tax on his half. Okay? Now, let's say he's getting sick. Right? Well, if he gets sick and dies with the stock in his name, and it will automatically get his half that he had automatically get stepped up too. So the children won't have a gain to worry about. What some people do is they start rushing it without good planning. They'll start thinking, oh, let's sell the stock before he, before she, they'll start making decisions. Like, for example, if they sold the stock when it was all in their joint names, they would have had a $90,000 tax on it, right? So anyway, just know, you don't have to know exactly how to do it or what percentages and stuff. Just know that if somebody is terminally ill, there's certain tax strategies that they should do. Now, there's certain gifting related stuff that should be done, but in some cases, if you give it within a certain period of time, it doesn't count as a gift. We're getting a little too much in the weeds with this stuff, but know that there is end of life planning that should be done. Definitely be. I'll tell you a quick story. I had a client whose father, it was him and his sister. I'm not going to say names, and this could be, let's say it's a hypothetical, but it's really a client of mine. Several years ago, father had an IRA, and this is when the estate tax rules were different. If the father died with the IRA in his name, he had I think it was $2 million IRA, $2 million IRA, and he had it in his name. He already was over the threshold. I think back then it was like 600,000 or maybe $1 million of estate taxes. It would not only be taxed income tax wise to the beneficiaries who were his were going to get the money, this man and his sister. So they were going to pay like $300,000 of income tax on it. Not only that, but it would have been included in his estate, another like $300,000 of tax. So I told him, end of life planning, maybe you should have your father, if it's really for sure that he is going to die in a few months, have him take the money out now and give it to you. And by pulling the money out of the IRA, it would reduce his estate by that much money. So it was like 30% of $2 million. It saved him about $600,000. When I brought up this idea, it was sort of like, I just found out that his father was dying. I just talked to him a little while. And then I said, well, did you think of doing that? And he says, oh, no. We have a CPA and a lawyer for the family for the last 30 years. No, this guy's sharp. No. He didn't tell us that. So I said, oh, really? Yeah, I'm pretty sure I'm right what I'm saying. And so I said, well, I'll double check what I'm saying, and I'll send you something on it. So I wrote it up a little bit, a few sentences, and I sent it to him. And then he showed it. Finally, the father says, oh, no, I don't want to get involved in that because the guys, I used them all my life. No, he knows what he's talking about. And I'm not saying it's critical of someone else, but nobody knows everything, there's always a new idea that comes along. And that's what you got to really be aware of. Always, for everything, but especially for taxes. Because it's like wasted money to pay taxes. So sure enough, he checked with the guy again. And the guy said, you're right. And now we only had days. Now the father, like a week went by, whatever, we had days. We had to really rush it to get the right forms, to get it done and everything. But they saved a significant amount of money. I'll never forget that. That brings up another point. It's one of the points on, this chart is a little too, this is my magic chart. This is a little too hard to go through on hold on a second. Had to bend down and pick up some paper. That chart's a little too hard to go through on this thing like this. But this other thing that reminded me of about saving people money. Let's say you have penalties, right? Penalties, because your parents were sick, everything went to hell. When that happened, you had to struggle. You had to find caregivers for them. You had to deal with it emotionally. You had to, live there for some time until whatever. Everything became much harder. So you let your own tax returns go. You didn't have any time. Your business went to hell. So you have penalties. Well, you show it to somebody and you say, well, I have these penalties. Well, that's a late payment penalty. That's a late filing penalty. And that's an underpayment penalty. Those are 3 of the penalties. And there's interest on that. Yeah, that's it. I mean, it was your fault, Baloney. You should almost always be able to get out of penalties. All right? And this is the story I want to tell you. I had a client. He was a friend, too. Again, not mentioning names. He was older than me. Very successful guy. And he went through, I did all the financial planning for him when he retired. He retired with about $10 million from the company that he worked for as one of the top people in the company. So at the same time, his wife had cancer, and the meds were making her like unstable and crazy. He was going through a lot of hard time. And he let everything go. I wasn't his accountant at that point. I just did his financial planning at that point. And everything went. And then at the end of doing the planning about what trusts to set up, I do that too. I'm a accredited estate planner and a personal financial specialist, which is another way to say certified financial planner, but it's through me being a CPA that I'm that. And then I also have a registered investment advisory corporation. So those of you that know me as a stand-up comedian, you're probably thinking I'm lying. You know what I mean? But anyway, I do have those credentials, and I do have a lot of experience at this stuff. Mainly because I've helped out a lot of families over the years, and I got the experience to be able to help people. So that's how I did that. Anyway, so I go to him and I said to him, he says to me, he says, "Oh, here's a notice I got. I'm just going to pay it. These penalties. Yeah, I was late. I know I was late. It was my fault." I says, "Oh, yeah, how much is it?" He says, $50,000. I never saw a penalty notice for $50,000. Well, maybe I did see one from another company. But anyway, $50,000. He says, "Yeah, but," he says, "now I want you to be my accountant, and we're not going to have that in the future." I said, "But wait a minute. Let's look at this notice. Why did this happen?" He says, "Oh, I was, my wife was driving me crazy, and she was going crazy, and she had the cancer, and then with work, I was like so stressed out about, properly when I should retire, and if I should retire, what should I do with the money, and this and that. And then I hired you, and you helped me with that and everything." And then the K1s were late. The scheduled K1s came in late. So anyway, I said to him, let me make up a name, Bill, because just so I could make it a conversation. I said, "Bill, let me write a letter, because I've written some good letters getting out of penalties. Let me write a letter to the IRS and explain that you were emotionally distraught because of your wife, and it was very difficult to handle all those responsibilities because she was sick, and the meds were making her crazy and everything. And then you had he started just going to see I got $10 million. They're going to say that's, I said, no, that's stressful to get, when you get a lot of money, you had to get the right people to help you with that and stuff." I said, "Let me write a letter." He says, "Oh, no," this guy was cheap. Not cheap. I shouldn't say he was cheap. He was frugal. He said, "I'm not going to pay," because he had just paid me $5,000 down payment on helping him with financial planning and stuff. He said, "I'm not going to pay. What am I going to pay you? $150 for the hour for writing the letter?" I said, "Well, maybe it'll take 2 hours to write the letter." "Well, I'm going to pay you $300, and they're not going to accept it." I said, "Well, all right. If you don't want to write, if you don't think it could work, and you don't want to pay me on the hourly basis, what if we worked on a percentage basis? Because I'm pretty confident I'm going to write a letter and we're going to get out of some of these penalties." He said to me, I'll never forget this. He said to me, "It'll never work. I tell you what," he said, Bill, I'm using Bill. Bill says, "I tell you what, I'll give you 50% of whatever we get out of for the penalties." That night I wrote the letter. It was a 1.5-page letter. I think I probably still have it, a copy of it. That if you want to see it, I laid out all the problems that the wife with the cancer, and she later, within a year or so died, and the drugs and everything, and then him with the complications with the financial planning and everything. I wrote the letter. I called him up the next morning. I said, "Ron, I wrote the letter. It took only an hour to write it. But it would have only been $150. But you said work on a percentage, and you said 50%. So here's the letter." So I read him the letter on the phone, and he said, "No effing way." So I said, wait, no. Why do you say that? He said, no. I said, "It's true, right?" He says, "Yeah, it's true, but they're not going to believe it. It's too crazy for them to believe." "No, But anyway, yeah, go ahead, mail it. I mailed it certified, mail. I guess I faxed it to him, or I don't know how I had him sign it, but I'm pretty sure I had him actually sign it. Sometimes you could just type the name on the bottom. You don't have to sign it. But I'm pretty sure this is a long time ago. It's about maybe 20 years ago. Within 3 weeks, we got an answer from the IRS, and my eyes went right to the middle of the page because that's usually where they have the answers as far as requests for waiving penalties and interest. And it said, we've reviewed the information and we agree to the removal of all penalties and related interest. It was $50,000 he got out of. Within a couple of days, he wrote me a check for $25,000. I took that letter that the IRS gave us on removing the $50,000 of penalties. I attached it to another letter to the state because there was $8,000 of penalties for the state. He wrote, and then that took another 3-4 weeks for them to get back to us on that. So he wrote me another check for 50% of the $8,000 or $4,000. And then because of the good job, and this was in the beginning of the relationship, really, because of the good job, he says, I want you to do the planning and the taxes for my 2 daughters. And so so I got money for that. That was really a good thing. But that led me, that convinced me that if you tell the truth, and usually it is the truth that is the reason why you incurred the penalties. You weren't flagrantly late. I mean, people don't do that, There's usually a reason for it. Sometimes it's a health-related reason or a family-related reason, or someone's in the middle of a divorce, and it could be very, very trying, especially on the children and then on the people, the couple. So anyway, that the lesson from that is if you ever have penalties, and there are 3 kinds of penalties, I won't go into them, and the related interest, just get to somebody. You could probably write the letter yourself, but there's certain guidelines on what is called reasonable cause. That's the reasonable cause. And you can't just say, I had too many things going on in my life. No, you'd say what it was. You send in a copy of the receipt from the nursing home where your mother was, and that was one of the reasons why you were late in getting your taxes in, is because you were always going there every other day to watch her and stuff. So anyway, that's that came up as an aside. All right, now, real estate, another problem situation right now, right? You own real estate, your tenants, half your tenants are paying you late or not paying you, or more than half, right? And depending on where you are, if you're in New York City, and there may be some relief that's provided with that or whatever, but generally, if your rental income is going down, also the value of your property is probably going down too. So it's not an easy exit. It's not like, I'll just sell it. No, you're not going to just sell it. It's going to be harder to sell it because an investor in real estate is looking, in that kind of real estate is looking, commercial real estate is looking for income, or even residential real estate is looking for that income, and they're not going to pay as much. So it may be, so now is the time to if you're not, now's the time to take some of those expenses. Also, if you're a real estate owner, you have probably some depreciable assets recorded on your Schedule E. Schedule E is for rental property. It's also for royalties. But you probably have some assets recorded. When you fixed up the kitchen and the bathroom and everything, you depreciated it over maybe 10 years. Well, maybe now now you're in almost in a forced sale situation. Well, let's say it differently. Let's say you fixed up commercial property. And now you don't have that tenant. That tenant's left the country right now, and you got to rip out a lot of that stuff that was in there. Well, you got to write that off, and the more you write off, the better. Except if your income is over, if you're a joint filer, so if it's over $150,000, you can only write off. You can only have a loss, a net loss of $25,000. The rest of it has to carry forward. You don't lose it. You won't lose it, but it just carries forward. So, but if you don't have a 25, you want to get up to showing losses. So you want to write off some assets related to your rental property. I want to go a little bit quicker through a lot of these. By the way, we talked about itemized deductions, and one of the deductions is for asset management fees that you're paying to a broker. It's time to talk to that broker and say, look, I paid you 1% of $300,000 that I have invested with you. It's $3,000. I pay that year in and year out. What I want to think about doing is, you don't want to, if the broker's been good for you and you've been making money and everything, you may not want to do this, but you might say, what would it be if you charge me a commission instead of the 1% asset management fee? Because we're not changing these investments that often, probably. The commissions, let's say the commissions come out to be the same, that, commission on this trade and that trade comes out to be $3,000. Well, that's not wasted, that $3,000 from a tax standpoint, because commissions gets added to the basis. Then when you go to sell that stock, it reduces the gain. So you get what I'm saying? If you're on an asset management fee, you're automatically not going to get any tax benefit from that fee. If you get into commission situation, you might. Now, if the person trades it a lot and it doesn't give you big discounts on the commissions, then you end up spending more money on commissions. So it's self-defeating. But chances are that's not the case. Chances are you'll do better on a commission basis, especially from a tax standpoint. Those are related to investors. Those are some of the things for investors. Let's go to the individuals part of this. By the way, I'm referring to a 3-page memo that I put out called Year-End Tax and Financial Planning for December 2020. I've been doing this for many years, different names or whatever, but always at the end of the year, I try to help people because there's things that you can do now. If you don't do them now, you're going to lose the opportunity. It's not really that complicated, but maybe the example I'm going to give is complicated. It's called bunching. And I feel bad for all those churches and all those charities and Goodwill and Big Brother, Big Sister and everything, because a lot of them haven't even realized it yet. It hasn't hit them in the head yet, and it's going to hit them. Because the contributions that you make are probably not deductible. So when people say to you, oh, well, give to our charity, it's tax deductible. It probably is not tax deductible because half the people file a standard deduction. They don't use itemized deductions, and a charitable contribution is only deductible as an itemized deduction. So recently I had a case it was doing it late. We did it late. She was out of town and stuff because of COVID. But we did a tax return, and she had given $12,000 to her church. A really generous, nice thing to do for a person on a fixed income, a retired woman. She gave $12,000 to her church, but she wasn't able to use it as an itemized deduction because she didn't have enough itemized deductions to come up to be $13,000 that she would get from a standard deduction, because she didn't have any state income taxes because her income was basically from a New York State pension, and she didn't have enough medical expenses, and she didn't live in a house. She had sold her house. So all of that money. So now what I said to her, well, we could talk to the priest. We ended up talking to the priest. I guess they didn't make a decision because we're now really at the end of the year, unless I get a call next week. But what I suggested to her is bunch her deductions. It's too late really for 2020 to do it. But for 2021, don't give that $12,000 during the year, but give it in 2022. So in 2022, you give $12,000 that you were going to give in 2021 to $12,022. Now you get $24,000. Now you could itemize your deductions. So instead of a $13,000 standard deduction, you have a $24,000 itemized deduction, right? That's $11,000 more. That will save about $3,000 in taxes. So that's what bunching is. You may have heard this term before. You bunch the expenses. Instead of spreading them out over a 2-year period, you bunch them all in one 2-year period in order to get qualified for itemized deductions. And that goes for other related expenses. I got off the phone yesterday with a client as a small business. She sells personal wear. I won't go into naming exactly what it is that she sells. But we went over all her expenses. She has a small business. She's an S corporation. This idea of timing the deduction. I said, well, did you pay your Con Ed bill? No, not yet. Pay it, because she has money in the cash account. So instead of paying it next month in January, pay it in December. We'll get it as an expense now. Pay me, the accountant. Pay me now in December. I'll take it in as income. I don't care. I'd rather have the money. So just paid me. What about your other expenses, like cable TV? The bonus that you were going to pay somebody in January, pay them now. Pay them in December. We'll get the expense now. So that's an example of timing it. Many of that, if you're a small business owner, you've been doing this for years. Also, if you have sales coming in, right, if there's a way that you could do it legally and technically, don't book the sale in 2020, right? Book it in 2021. So you minimize your income in 2020. All right. We talked about SALT, which is state and local taxes. This comes under the category individuals and families. This may be a little, I don't want to get into this. Is there's lots of complications with this, but consider if you have, if your income is high, let's say high is $180,000 or more, you are not getting any credit for when you're paying $50,000 for your daughter or son's education. You don't even get any credit. There's the American Opportunity Credit and all that. You don't even get it because your income is too high. You're knocked out. You're considered too wealthy to benefit for that credit. So what you can consider doing, I've done this for people, is give the money to now this is if your child is already making money someplace with a part-time job. Hopefully they are. If they're, in college, 19, 20, they're working. Give them the money that you would have paid to the college, or give them some of the money. Have them make the payment, and then because they have lower income, they will be able to get the credit. Sometimes it's an easy $2,500 that you can make. Now, that's one idea, is giving them the money. There's another thing, talking about families. If your daughter or son live at home or live near you, and you can enroll, and you have a small business, or you have or you're employed, say you're a gig worker, or you're a remote worker, and you have stuff in your house that you can give them to do because you're not doing it in the office. It's not like you have to bring them into the office. You got stuff for them to file, to call people, to prepare a report, to get online, to do social media, all that stuff. Pay them, right? So the money that you pay to them is a valid expense from you, reduces your income. If you're in a 30% bracket, say counting state, and you paid them $3,000, 30% of $3,000 is $900 you saved in taxes. On their side, right, they picked up, what did we, 30, what did we say, 10, $3,000. You paid them $3,000. They pick up $3,000. They don't have any taxes on that. Now, it does create a little bit of an extra thing because you got to then file payroll tax returns for them and stuff like that. But many accountants are already set up for that. You know, plus ADP or Paychecks could do that stuff pretty easily. I've done that for several clients. All right. We had the children beyond the books. And it has the extra benefit of it increases their income. It shows up better for credit. They're able to get credit cards and develop a credit history. And also looking at pandemic, and then we're going to move over to pandemic stuff. From a pandemic situation, they're more likely to be able to get unemployment. Let's say we went into a deeper surge, or the vaccines don't work right, or whatever it is, and we're encountering problems ahead. You could fire them, you know, after you have them on the payroll, and then they could collect unemployment based on the income you paid them, depending on how much income, what quarters were used, and everything. But it has that's a possible other strategy. So that kind of finishes it for. If you have I'd stay with individuals a little bit more. If you have high medical expenses for parents, I'm just going to mention this. They were paying it out of their money, right? You might, and they ran out of money, and now you're paying some of it, right? Well, you may want to put them on as a dependent, and if you put them on as a dependent, the requirements on this is a little tricky, but you might be able to do that. Talking about credit, with credit card companies, you should be able to work out. You're behind. Many of you have already worked it out. I know for a fact Chase is reducing to 6%. So instead of paying 29.9 or whatever ridiculous interest rate, they should have never been able to pay that, because it hurts the middle income and lower income people more than the wealthy people. Should have never been able to pay that, have been able to charge that. But you can reduce that to 6%. And I know in certain cases for certain accounts with Citi, they're reducing it to 0%. With a 60 or 58 month workout arrangement. So if you have credit cards, everybody wants to think positive. Yeah, things are going to work out better and everything. I'll get myself back on track and everything, and I'll pay this. But if you're up to the max anyway with the card, you might as well shut the card down through with them and work out a deal with them of paying it over a 60-month period of time or close to that at 0 or 6% instead of 29%. Let's say you had $5,000 and you were paying 30%. And now it's 0. You just saved yourself 5,000 times 30% is $1,500. You save yourself $1,500 a year just by making that call and working that out, right? It shouldn't affect your credit that negatively. Put it this way: if it stays at the 30%. And the shorter period of time paying it off, and you can't make those minimum payments, you're earning your credit anyway. This is a quick mention. This is to the very wealthy who may be listening. If you got over $12 million in assets, you're above the threshold, the lifetime threshold for estate taxes. So there's rumor that that's going to be reduced pretty substantially, maybe more down closer to $3 million or $5 million. So if you thinking of gifts, making gifts, this is a good time to make gifts. Get it out of your ownership, into someone else's. So now I'm going to move over. Those were for individuals and families, and we had a few small business things thrown in there. How is it so far? I should. Are there comments, questions we have here? I don't. Oh, I got a comment from somebody that says, "How do you know all this?" Well, let's say it came from a guy named Fred. Fred, this has all been. This has been one big, long. I didn't want to say it until the end, but it's been one big, long joke. I know none of this is true. I just made it up as it was going. No. I figured I'd give people a heart attack. No, I've been a CPA. I was with Price Waterhouse. I was with the top firm for 6 years. They were the white shoe, the best firm you could be with. I mean, the others were good too, Arthur Anderson and stuff, Pete Marwick and stuff. But PW was the best. And I was a manager with that. I knew my stuff, And then when I left them, I started my own business. I was in my own retail business, so I knew firsthand what to do with cash and everything and retail and how to what really worked in a small business, what you really had to struggle with. And then I had clients, other small business clients. So all my life I've been doing this. So it's like whoever people know, whatever they know, and they know because they can call on those experiences. As I've been trying to call on those experiences. So anyway, we want to do the pandemic now. This is very important. I want to say this right up front. I helped 27 people get, I'm not saying, hey, look at me, but I just want to let you know, I had the experience of helping 27 people get money when they desperately needed it from the SBA, EIDL, Economic Injury and Disaster Loan and Grant situation. Some people, it was just a $1,000 grant. We filled out an application, sent it in online. They got $1,000. I charged them $150, which was the most I could charge. Some people got $50,000, $15,000, $80,000, $75,000, $100,000, $150,000. I think that was the largest one that I did. Many people got, and that was based on sort of their revenue, and I'm hoping that comes back. I was able to get that kind of money, and in those cases, for those $150,000 person that got that loan, a 30-year loan at 3.75%, damn good deal. Even if it turns out that she's going to pay whatever, $3,000 in interest, if she doesn't use it, it is so comforting to have that money on the side when you're in a small business. Because if you got, as you can see, if you get shut down for a few months, you're, I know many years ago when I was in a retail business, I had like 3 quarters, terrible quarters in a row. It was a deep recession. It basically put me out of business. I mean, I went out voluntarily, but it basically put me out of business because I didn't have any reserves. And I couldn't go for more loans at that time. So if you can get a loan now, get the loan. It makes all the sense in the world to get it. So anyway, when that comes back, I'm going to be in that big time. Bigger than that, bigger than 27 people. I'm going to spend quite a bit of time on it. So that's why I'm also trying to get my this tax work done early on this year. So if you're thinking of, getting my help with taxes or whatever, do it. Don't leave it until April, because April, May, and even with the extensions and stuff, because I'm going to be really in the thick of, because I do anticipate some stimulus and stuff. And SBA kind of help, and not only with the SBA but with others for lending, because there are a lot of businesses that could be saved with borrowed money. Okay, so pandemic. So that's one thing I wanted to mention that in the beginning. Also, unemployment benefits. unemployment's a very tricky area. You know, you can't just say, "Oh, I'm a business. I own a business, and therefore I'll collect unemployment." No, no. The pandemic, PUA, the pandemic unemployment assistance, that helped a bit in that they said they were going to pay $600 a week. Quite generous, I thought, to business owners, to people, but also if you were, they loosened the rules for business owners. Usually, if you didn't have a W-2, you couldn't get it, unemployment insurance. But they said, okay, we'll allow for self-employed people, just show us what your net income was, basically, and we'll treat it like that, and we'll give you the $600, plus we'll give you, let's say, New York State or New Jersey, Connecticut, whatever, unemployment. So, but it takes sometimes a lot of hounding to unemployment people and having the right records and sending them in. And sometimes it means not making up records. I don't mean it like making up, but recording it. So, and this happened with, I had a client in their own business. You know, as life happens, you have problems or whatever. In his own business, never was on salary. It was his business. He wasn't on salary. He was taking money out of the business. Because he didn't have a W-2 or 941 payroll tax returns or New York State 45s, because he didn't have those documents, he wasn't getting unemployment. So now what we did is I showed him how to get the payroll, and I prepared the payroll tax returns. We filed them. He followed it up. He came to my house outside one day. We called him up and everything. Then he followed it up on his own for much more time. He's going to get, and then it went back retroactive. He's going to get something like $25,000 came out of my doing $1,000 or $2,000 worth of work. You know, he's getting that retroactive, and now he's set to collect that in the future. So unemployment is a complicated area. It's good to go to somebody who's already been through it, you know, and ask around. You know, ask around to your friends and family. Well, how did you do it? You're in a business like mine. How did you do it? Or you're an employee. What did you do? Oh, I called this number, and I kept on calling them. And I called at 8 o'clock at night, and they were still open, and I got whatever. Talk to people about things. The CARES Act has some, you know, one thing that you probably know, especially if you're older, is that required minimum distributions did not have to be done this year. An RMD, required minimum distribution, is basically the amount of money that you have to take out of your IRA once you pass 70 and a half. Or for certain people who were born at a certain date in 1949 or later, 72. Okay, so once you find that's the amount you take. Now, so for some people, I have some clients, they've taken out, say, $30,000 a year, they need that money, so it's not an option. I'll just leave it in because they need the money. But for other people, it is an option that they could say, well, if I don't have to take it out, if I take out $30,000, I'm basically going to be paying $9,000 of taxes. I'll leave it in, right? Now, if you could leave it in. Now, so 2020, it's definite. You didn't have to do RMDs. Probably, my guess is that it's going to be that way for 2021 also. Now, don't forget on this thinking, this is for when you have income. When you don't have income, as is in the case for many millions of people in 2020, because they didn't have the job and their businesses went downhill. If you have losses, this could be the exact time, we went over this earlier in quite a bit of detail, to take the money out, because when you take the money out, it creates income to offset against the loss. And what happens is that you have money in your hand outside of an IRA now that is never going to be taxed, right? So you avoid that tax in the future. So it's a permanent tax savings. That's And I've done that with many people. That's a very, very important thing to do. Now, so the CARES Act also mentioned that certain people could take out early distributions up to $100,000, even if they were under 59.5, which is there's a penalty if you did it under 59.5. You have a penalty. Well, certain cases you can get, and chances are you could prove your case. If almost everybody can prove their case now that they're not doing as well, and the loans you could pay them back by. They had a date, October 15th, 21. You could pay back if you took loans from a 401k plan. If you could prove it was because of a lost job, but I assume there it's also because of a lost business or a declining business. Just this is for another point for employees, just as a way to set you up on this. There was a good article. You could always, by the way, if you want to contact me, you could Facebook message me, put it that way. And then my Facebook message me, and in that message, give me your cell phone number and your email. I prefer to do business. My main way to do business is by phone. I could do business anyway, but the phone I feel is the most, or FaceTime or Zoom or whatever, but live. Because people, then you have a conversation. Somebody says something, you answer it, you go back and forth. And some of the stuff is so complicated. If you do it by email, it'll take you forever, right? But you sending me documents and everything like that, great. But discussions are better by phone. But anyway, Francis Sisco, Francis, like the Pope. It's my baptismal name. And my last name is Sisco, Sisco. On Facebook, I'm all over Facebook. Mostly for comedy, singing, poetry, all my right brain stuff that I love to do. And I haven't really put much in the way of financial stuff up there, but I have it up there. Or my website, and my website is trans, because I'm transgender, Fran, Fran, Sisco, Sisco.com, Trans Francisco. The San Francisco treat, right? Trans Francisco. And I have my website, the tabs on the top are left brain or right brain. Left brain, as you know, is analytical, like logical, sequential. Right brain is more like lateral thinking, creative, relationship oriented. So I'd like to split my website up that way. So if you're looking for my paintings and sculptures, if you are, it's on the right brain side. If you're looking for taxes or financial or investments or insurance, by the way, term insurance, it's still cheap. Get it. If you have, and many people have been losing their universal life insurance or their whole life insurance because they can't afford the premium. Your term insurance, don't let it go. Don't let it go. You could get a big policy for hundreds of dollars. You know what I mean? So you want to definitely, I can help you with that too. But get a quote. Go to, what's that thing? You hear it all the time on the radio. Quick quotes or whatever. Just Google term life insurance quotes. Get some quotes, then call me with those quotes, and I'll see if I could beat them. But anyway, you want to have at least $500,000 of term life insurance. You know, if you have a child, for sure. If you're married, for sure. If you're in a long-term relationship, for sure, you want to have that. And you want to have enough that even if you're on your own completely, you don't want to leave anyone else with a problem to clean up the mess. You know, you want to have some insurance, right? Anyway, that was just an aside. So, what I was getting to is remote workers. There was an article the other day. It was good. A lot of people working remotely, right? Let's say you're an investment banker, right? And you're working on your own, and you're a banker for 4 different companies, and they're in different states, right? And you're serving them. Well, you're making sales of your services, really, to these different 4 states. So therefore, you may have different state tax problems. Some state, Idaho, may say, you owe them money because you did work, even though it was by internet, it was in the ether, you did work to benefit that relates to that client in that state, or, where is the nexus? Where is the situs, or they call it, where your business really is? Maybe your business is really in that state that you're serving that client, or you're working off of servers in that state. So anyway, these can be complicated issues. Just a heads up about that. It's something different because there's millions more people who are working remotely now than were working that way before. All right, this small business. There's a couple more, and then we're going to call it the end. I've got a 4:30. Small business owners and gig workers. Gig workers are like people who work per gig, but it could be not just dressing up and being a clown for a party as a gig, but it could be doing some sophisticated analytical work, for a company. That's a gig. A gig is like per event, and gig workers also are delivery people and things. People that are paid usually by 1099, miscellaneous. And don't forget, if you're paid on a 1099 basis, you're subject to self-employment tax. So it's very, very important to get all the expenses possible as a small business owner and use a cash basis, okay? Mostly you're using cash basis, and you want to pay as many expenses. Also, an easy expense for a small business person is a car expense. And your small business doesn't necessarily have to be a retail thing or selling widgets over the internet. Small business could be being an actor. You took some acting classes, you made yourself $3,000 in acting gigs, or you're a singer and you got a guitar and you started singing some songs and you're making some money that way. These are filing a Schedule C. You're getting a 1099 from who you did the work for, or in many cases, if you did the work on your own, no one's giving you the restaurant that you go into to sing some songs on a Friday night. They're not giving you a 1099. It's cash, probably. They probably hand you like $400 and $400 in cash. That's it. Now you go to report that. You want to have expenses to offset that. Well, you have car expenses. Big expense. I think it's 58 cents a mile now. It's easy. You worked you went at least 5,000 miles that year, on these different things. Maybe 10,000. Maybe you had 15,000 annual miles. 10,000 was business. If it was 10,000, it's a $5,800 deduction. That saves about $1,500 of taxes. So don't overlook that expense. Also, if you're in the entertainment field, which I am, hopefully on a higher earning method than so far, I haven't really earned that much, but I'm intending to. But almost everything you do, for example, I've written a couple of plays, right? Now, when I go to a play, which I haven't done much since March, but when I go to a concert, even virtually, when I pay $35 to go, which I'm going to do tonight, to see something, that's all deductible. Entertainers, there was an entertainer on earlier, a singer. All of that stuff is all deductible. If you're a writer, almost everything you do is fodder, is stuff related to something that you're going to write. You're writing now or writing. If you're a filmmaker, forget about it. Everything is related to that. Almost all of your expenses, not the food that you put in your mouth, but the food that you give to somebody else is the place that you go, all the things that you do, a lot of that is expendable, is expensible. All right, you got to get guidance on that. You don't start making up numbers and stuff. But if you go through it, you'll find that a lot of conferences you attend and a lot of things you think you were doing for personal growth and stuff like that are really business related, especially if you're in the arts field, like entertainers, writers, artists, actors, filmmakers. Okay, and art, it's not just the art. It's not just the paint and the canvas, or say in my case also sculptures. It's not just the tools and stuff. It's the meetings, the places that you go. It's the hobnobbing. It's the all the computer expenses, internet expenses, and stuff like that. Everything that you do, the books you buy, all of that stuff. Okay, so don't forget about that. There's a last point here under small businesses. If you're in an unprofitable, inactive business, it's hard to see that right now because so many people are in that situation. But chances are, I think of this time as the Great Awakening. You know, that we're really getting in touch with our priorities and stuff. And too long, you may have been in a business that really hasn't been worth it. You were a barber. You're making not much money, maybe. And now people are really reluctant to go and be treated as often. You know, sometimes they'll need their haircut. Sometimes they'll do it on their own now. So think about what business you're in and whether there's a way to change that business to be less dependent on personal service, touchy-feely kind of personal service. Because even though hopefully we're going to get through this with the vaccines and everything else, we still are vulnerable, very, very vulnerable to the next time it happens, either because it was a bacteria or a virus or because it was a terrorist or it was something else, you know? So the world is a lot riskier. So use this as an opportunity to think about your business, whether it makes sense, you know? Definitely, if you were thinking of expanding your business, maybe you pull those back and spend that time and money on your family instead of on the business. Instead of building a branch in another location, you know, to expand, because that's success, you know. Maybe the success comes in terms of having a successful relationship with a family member or a friend. So anyway, so that's those are my high points. Those are the high points from my year-end tax and financial. My email name, if you want to email me, it's easier, franciscisco@aol.com. The website is, I should make a sign, like, and hold it up so you can see it easy. transfrancisco.com. And you know what? Next time I'll probably give the phone. You email me, I'll give you my phone number because I love to talk. That you got from this. I promise you, if you have me do your taxes, I'm not going to waste your time by talking too much. All right, so don't worry about that. And I'm right in New Rochelle, the north end of New Rochelle, which is in Westchester County in New York State. Everything can be done, you know, I send out the tax returns by PDFs and stuff like that. I can get the material. We don't have to see each other personally, but I am in my own house. I have a large office that, I don't know, I don't think I'm going to show you that much of it because it's a little messy right now, but I have got a nice size office, and I have another office, and then I have an outside. So, back porch, back patio, and front porch. If you have to come, we have to exchange stuff. We put on a mask and we do it, you know. So we have that. I have a large driveway. It could fit about 8 cars in, and I'm right off the Hutchinson River Parkway. I'm 32 minutes from Manhattan. GW Bridge. A half an hour, not even 25 minutes from GW Bridge. I can get into New York City by car, by train. So if you have businesses in that area and you want me to come down and visit with you. So anyway, but like I say, it's not just, I just wanted to reach out and help people during this time of year. There's stuff to do before the end of the year for your taxes. So hopefully you got that. If you missed part of it and you want at least this 3-page guide, I can email that to you. No cost. And I'm going to have another one of these. I'm going to be more organized in it. This, I was running late because I had so many things coming up in the last several days. I'm going to do a Zoom call where people could come on. They can ask questions. I'll have on probably a guest, a featured guest, about a particular industry or whatever. And so anyway, so thanks a lot. Thank you. Let's see does anyone have any particular question you want me to answer? No, I just want to do a shout out to Anthony. I'm so glad, you're back and everything is going all right for you. I don't know if you saw that video I put up of you singing in the still of the night with Richie and Skip and Paulie, But anyway, hopefully you saw that. Mike, good to see you. And yeah, let's talk. That's great. And Jane, and I know there were loads of people before. We had a number of people coming on. And this is very, we all have things that we are great at. Like, Mike, you're a great singer, right? It gives you pleasure, right, to sing. Even if it's just that somebody calls you up to sing a song and you're not getting paid for it, it gives you pleasure. This gives me pleasure to help people because it's something I do well. So anyway, and thank you for attending. And we're gonna go. There's an organization. I just want to mention it. I want to plug them because I'm going on the call in 20 minutes. It's called TRU, TRU, Theater Resources Unlimited. It's great when they have a Friday afternoon meeting. It goes, I hope it's 4:30, not 4. Yeah, it's 4:30. It goes from like 4:30 to 6. They're going to follow it with, I think, the Christmas Carol online play or whatever. But this organization, TRU, is very good. I've been with them for a couple of years now. And it's a group of actors, mostly directors, writers, producers, musicals. They do a lot of musicals. There are about 80 people, 70 or 80 people come on the Zoom call. And in the beginning of the call, for the first 15 minutes, people are just introducing themselves. Oh, I do this, I do this, I do. And you can get it from the chat. You get all these contacts. I made a number of contacts. That's a great organization. Another organization. So you out there, if you're in that entertainment field, TRU, TRU, it's only like maybe a $35 membership fee for the year. It's like incredible. And they have these weekly meetings and then they have seminars and loads of stuff. Phenomenal. There are, the Episcopal Actors Guild is excellent. It's in the city. You don't have to be Episcopal. You don't have to believe in God, actually. God help you if you don't, but but anyway, they're really great. I curated a show for them recently on October 18th. It was a big hit, actually. We had about 26 performers, and I curated the show and produced the show with them, and they're a great bunch. And they have they have a monthly actors meeting. So if you're an actor, you want to have a good class, and you're tight on money right now, this is a really good opportunity. There's another group I'm involved in called the Brazen Giant Ensemble, especially if you're an actor, director, writer. It's a group of about 25, maybe 20, 25 people. We meet every other Thursday evening from 7 to 10. Excellent group. You got an audition you're going on, you want to try out a monologue, you could do it there. You just wrote a script and you need 10 people to do a table read, you could do it through there. You're a musician, you want to hook up with a songwriter because you're better at the music and somebody, you could do it there. It's an incredible, and there are loads, and you all know loads of these organizations, and we're all, and you know, the Harrison Players is wonderful if you want to put on a play or be in a play or whatever. I know them well, and you know, there's so many that I'm leaving out, but reach out, and for taxes, reach out, and if we don't click, I might get you, or maybe I can't help you. Maybe it needs someone who has a special experience in another area. I'll get you to I'll make a few phone calls and we could set it up. I'll get you to somebody that can help you. Okay? All right. Anyway, check out Facebook. Check out my daughter Kelly singing Feliz Navidad. And also she did Life is But a Dream. And she did a few others. Give her some likes. It's good for the self-confidence. All right. Take care. Bye.